happens when you are injured or get sick, too sick to work, or you have chronic pain that prevents you from working? You still have bills to pay, don't you? You have your mortgage / rent, you have your cable bill, you have a cell phone bill, if you have a house phone, you have your hydro, you have your water, you have everything.
What would you say is your biggest
but
asset?
you don't have an income.
You might think it's your car,
So today
home,
we are
or
talking
maybe
about
your
an
investment
insurance
portfolio.
policy
In
that
reality,
takes care of that.
it's likely your ability to
And that
work and earn
insurance
an
policy
income.
is called disability
So what would happen
insurance.
if
So watch this video right to the end, and it will give you all to you need to do exactly. This is called disability insurance, or DI for short. An insurance policy that protects nothing but your income. It protects your pocketbook. It protects the income so that you can keep on paying those bills. You still have if you have a car payment to make, you still have to make it. Whether you are injured or not, your creditors do not know that you're too sick to work. They still need their money. So what is disability insurance? This is a type of a coverage that gives you protection against a chance of losing income if you become disabled or not able to work, and hence not able to pay your bills. And not all disabilities are visible to the naked eye. We have chronic pain, and we also have mental issues. They are all covered under disability insurance. There are myths out there that for you to be able to receive disability insurance, you must have been injured at work. The facts are the following. Someone who spent months recuperating from a car accident can still receive disability from his or her workplace. A carpenter who has broken an arm while skilled in Montreal can still receive disability. And an overworked physician who is told to take it easy after a heart attack can still receive disability. Someone undergoing chemotherapy and which has sapped energy out of him or her can still receive disability. And someone who has been diagnosed with a major disorder following a traumatic event, you witness anything that is traumatic, you can still receive disability. A school teacher who is suffering from insomnia can still. So now let's dig deep. What does the disability insurance, this DI, what does it do? It replaces income. So disability insurance replaces your income. However, it doesn't replace 100% of your income, but it gives you enough to keep you going while you are not working. So the income is depending with the plan you have. It replaces 60 to 80% of your last income. I will share with you something which happened, a personal experience. I went on a disability which lasted for 3 months. While I was on disability, my co-workers back at work started receiving a raise. So I went to the disability company and said, all my co-workers have just received a raise. So can I get a raise on my disability? They are like, no. It's calculated on the last income you made. So bear in mind that it's calculated on the regular income which you are making prior to going on a disability. So in the United States of America, you can get disability through social insurance,
the Social Security,
through an employer, and through your own private company. Here in Canada, you can get disability through EI, employment insurance. You can get disability through an employer, and also you can get disability through a private company. So let's look into the variables that determine the cost of disability. The disability insurance is determined by your age. The younger you are, the less you pay. You're healthy. Do you have any history of disabilities, back pain, or previous injuries? The job and hobbies. A commercial truck driver pay more on disability, or a construction worker. These two people are likely to be injured than an office employee. The strictness for qualifying can also determine the price of your disability. The length of the time which you are to receive the benefits for can also determine the price. The length of the policyholder must wait. We have an elimination period where the policyholder has to wait until he or she can receive the benefits. So the longer it is, the less you pay. So these are the variables that determine your premiums on DI. So in USA, to qualify for government-sponsored disability
The
insurance,
Social
you have
Security
to
Trustees
prove
Report
that
is announced
you
every
cannot
summer,
engage in
and it
any
gives the economic
type of
health of
work.
the Social
Also,
Security
you
Trust
have to
funds
prove
going
that your
forward. And based on last
disability
summer's
will
report,
last
it's indicated
for
that by
12 months
2035,
is
there'll only be enough
likely
money coming in to pay.
So, on contrast, private plans applicants can demonstrate they can no longer continue to work in the same line of work which they were previously engaged in, and the terms of conditions are favorable to the insured, the more premiums you pay. So let's unpack this a little bit. So if you wait shorter, you receive a bit longer, and the more the conditions are favorable to you, the more the premiums which you pay. Less elimination period, high premium, as I said. How strict the definition of disability is will also affect your premium. So if they have a high standard of proving your disability, so which means that you pay less, it is very favorable to you that, oh, I have insomnia, okay, disability, then that means you pay more. The more favorable the conditions are to the policy holder, the more are your premiums. So how do you save money on disability? How do you save so you don't pay more, you pay less? Everybody wants to pay less, correct? You buy when you're young. Before we get to that, disability, you can either get it from a private insurer, which is on your own. You can get it from a group, which is sponsored by an employer, or you can get it through government. Here in Canada, through EI, Employment Insurance. And if you are buying it on your own, that is private. You have to buy it when you are young. You have to choose longer elimination period. The more you wait, as I said, the less you pay. Anywhere between 30 to 90 days. But the rule of the thumb in most cases is 30 days. For short-term disability, you apply, and then you wait for 30 days before you can start receiving your benefits. You choose a shorter period which you can receive. If you choose a period which is longer, say like 12 months for short-term disability, the more you pay in premiums. So some policies include lock-in rates, annual cost of living increase, and the premium suspension during the unemployment, and the benefit stops when the period ends or when you return to work. You go on disability insurance, you start receiving benefits. There is a period, say, which you agree to. Most of the short-term disability sponsored by employers here in Canada is 6 months. If you choose your own private disability insurance plan, it can go up to 12 months. So say, assuming that you chose 12 months, your benefits will last up to 12 months and they'll stop. That's for short-term disability. Or as soon as you return to work, if say you have a disability insurance that takes you to 12 months and you only claim for 2 months, you will return to work, your benefit stops right there. So you can go on disability on short term until your benefits runs out, which is at the end of the period agreed upon, or they can stop as soon as you feel okay to go to work. Let me also share with you something. Some disabilities companies, what's your disability? Like my personal experience, where I was going to my own doctor, filling in some certification that I'm still unable to work, but they can counter that. They can now hire their own physician to evaluate you and give them a report. So their own physician who normally write what is more favorable to them. They would tell them what they want to hear. In my case, their physician wrote that I was fit to go back to my work because my work wasn't physical enough, wasn't physical at all, in fact. So this is some of the things that happen when you're on disability insurance. Let's look into short-term versus long-term. So with disabilities, we have short-term, which runs up to 6 months to a year to 12 months. A long-term disability starts as soon as short-term stops. When short-term stops, long-term takes over. Long-term disability can go from 2 years. Here in Canada, it can go from 2 years to about until you are age 65 or a lifetime. Now, if you choose a long-term disability that lasts a lifetime, that means you have to pay heavily on premiums. The best is to choose a plan that runs out at age 65. It's either from 2 years to age 60. So let's look at short-term disability and long-term disability. Let's compare and contrast them. The short-term takes effect before the long-term. So you receive less than 70% on your regular salary on short-term, and on a long-term, it's a percentage of your income determined by the disability company, which is between 60 to 85%. But rarely, I don't know if there is any out there. Probably there could be a very generous plan out there, but obviously you have to pay more for it, which gives you 100%. All the plans which I've looked into, they pay up to 85%. So on a long term, you receive 85%. It's valid for a specified period of time calculated in weeks. That's the short term. And with the benefits are paid for a period determined by your contract until the age 65 or lifetime, as I said. That's the long term versus short term. So the short term is valid for the period calculated depending on your contract, and the short term, it's up to age 65 or lifetime depending with the contract. That takes a lifetime. Most of the contracts, they get up to 65. Here in Canada, if short-term disability is not available, you are entitled to EI. We'll get to that. And some contracts provide a waiver of premiums while disabled. So that is on long term. When you are disabled, you go on a long-term disability. So the best route to go for the best rider you can put on is that you put a rider that whenever you are on disability, you don't have to pay into your DI plan. This is the best way to do it. Group versus individual plan. Let's go compare and contrast. Group versus individual plan. Group is offered by companies for all its employees or people in a particular profession, whereas an individual plan, you can purchase it on your own. And most it's underwritten for you, specifically for you. In a group plan, you cannot choose your coverage, whereas in an individual plan, you can choose your. So in a group plan, the employer and the insurance company, they sit down, they draft what suit all their employees. So in a group plan, the plan is handed to you. Here are the terms and conditions for you. This is what you get when this happens. This is the elimination period. This is the coverage period. So in a group, everything is handed over to you. Whereas in a private individual plan, it's you versus the company you are applying for. So you sit down with them, you draft or you put together a plan that best suits you. These are the difference between a group plan. So all those things I talked about in a group plan, they are given to you. the employer choose a plan that suits everybody, that suits each and every individual. It will also be handed over to the current employees, to the future employees. In a group plan, the employer chooses the plan with the company for you. In an individual plan, it's you who chooses what you want to cover. So things which I talked about, buy when you are young, choose a longer elimination period, choose a shorter benefit period, all those choices, they are not available in a group plan. Because the plan is given to you. Let's look at some of the features of the DI plan. When you are receiving benefits, if your group plan is paid by an employer, benefits are taxable. You pay tax. As you know that death and taxes are the two inevitables.
Money is on the minds of many as tax season opens up. Today is the first day that
many employers offer full-time employees group short-term and long-term disability coverage benefits. In Canada, I would say like most of the publicly traded companies, they do have some sort of this plan. But in some cases, in some lower-end jobs, the plan are not that favorable to the employees, or they might have a longer elimination period, short benefit period. And individuals can also purchase their own disability plan to supplement that group, which is offered by the employer. So group plans are tied to your employment, whereas if you purchase your own plan, it's portable. You can go wherever with it as long as you continue to pay the premiums. So individuals with plans that have higher premiums but better benefits, because of applicants are individually underwritten. If you have an individual plan, as I said before, that you sit down with the company, you choose what's best for you, they look at your age, they look at your health, no history of disabilities, you have no history of back pain, chronic pain, arthritis, all those, they look at that. It's individually, so as a result, you get a favorable plan, especially designed for you. Whereas the group plan, as I said before, is an employer try to decide what suits everybody, what is generally good for everybody. And hence the individual plan, it tends to be better than you can choose your elimination period, the waiting period. You can choose your period of payments. If for short term, you want them to go for 12 months, as I said, or for the long term, you want them to go for up to age 65 or past age 65. All those are the individual choices you make. Individual policies may be issued with limit claims that are due to pre-existing conditions. Suppose you have a pre-existing condition, as I just talked earlier on, that you have back pain, you have had these injuries at skin results, or you were a professional sports player who has a lot of injuries. So when they are underwriting your policy, they will have to take that into consideration and hence determine the premiums. In Canada, if employees do not provide short-term plan, the government will come in. You are entitled to. So let's look a little bit of what EI. If your employer doesn't offer a short-term, the EI will come in. You claim from EI. So eligibility is that you have used your sick leave and you have worked sufficient hours. They want you to have worked up to 600 hours prior to claiming, and you have also used up all your sick leave. And employment insurance disability, you claim a 30-day elimination period and you claim for 15 weeks. You receive your benefits period runs for 15 weeks or whenever you are ready to go back to work. So it's 15 weeks or back to work, whichever comes first. So at 15 weeks, it will end. Or if you, as soon as you got back to work, you don't necessarily have to wait until right to the end of the disability period, you receive only 55% of the income. So here in Canada, it's not as stringent as the American one. It's not as strict as the American one, where you have to prove that you cannot work at any job, or you have to prove that your disability it will last for 12 months, or it's likely to cause death. The requirement for you to receive government employment insurance short. That means your employer is not providing one. That's one thing. And you don't have your own plan. Secondly. And third, you have exhausted the employer's sick leave. And thirdly, you have worked sufficient hours, 600 hours prior to the application of that sick leave, and you go through the elimination period, which is 30 days, and you start receiving the benefits. And the benefits for 15 weeks. After 15 weeks, the benefits run out if you are not yet fit to go back to work. Then also you can either go on a long term. They also provide a long term, which will come to it. Also, on a short term, you receive 55% of the income which were getting prior to going on disability, or maximum. The current one right now, according to the update on the government website as of 2024, it is $638 per week. That's the maximum. It's either 55% of your income which you were making, or the maximum. That's as per government website as of 2024. I looked at the last updates were made in 2024. So 2024, $638 per week, or 55%, whichever is greater, whichever is larger. That's the amount which you receive. After the disability, the short-term disability runs out, the government, if you don't have your own disability, you can go on their long-term disability. Their long-term disability comes in when the short-term disability ends. The conditions are, you have exhausted the short-term disability, you have also exhausted the employer leave credit, you have exhausted employment insurance benefits. Employment insurance benefit here, they run up to 1 year. Here's what happens. You go on a short-term disability, you get 55% of your income, or $638 per week. And this runs for 15 weeks. The 15 weeks runs out, you are still not able to go to work. You apply EI. Now, you go on unemployment insurance benefits. Employment insurance benefits will run for 1 year, 12 months now from the period you start claiming them. They will go for 12 months. At the end of the 12 months, you still cannot go back to work. You go on now on a government long-term disability, which gives you 60 to 70% of your income, which you were making prior to being disabled. You'll be covered 2 years or up to age 65. Now, for you to be covered up to age 65, there are certain medical requirements which you have to meet. The doctor has to certify that your disability prevents you from doing any job. So there are certain requirements which they will need from your personal physician for your disability to go up to age 6. After what happens after age 65, then you start claiming your Canada pension plan. You have to prove that you have severe, prolonged physical or mental disability for your disability to go all the way to age 6. Government, they have strict requirements. They are not as generous as your own plan. And your doctor also has to certify that your disability prevents you from working any regular job. So these are the requirements. So, ladies and gentlemen, this is the plan which we have been talking about today, called Disability Insurance Plan. You can have it through an employer, you can have it through private companies, or you can have it through government. With governments tend to be more strict requirements for you to qualify for their disability insurance. So thank you, ladies and gentlemen, for watching this video right to the end. So subscribe.